Welcome to Real Estate 360, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate 360, Tom K. Wilson.
Thanks for tuning in to our Real Estate 360 program, your number one source for all of your real estate needs and education. We're broadcasting from the number one business radio station in San Francisco Bay Area, KDOW AM 1220, the Wall Street Business Network. I'm Tom Wilson, your host for the Wednesday edition of Real Estate 360 that comes to you daily, Monday through Friday at 3 p.m., along with my co-host, Joe Kuchera and Lori Graymont. If you can't make the live show, you can catch our podcast on RE360radio.com, and you can catch my programs on TomWilsonProperties.com or on iTunes. Look under Wilson Investment Properties. Today we're going to go to part two of our discussion of multifamily properties. And we will focus on that, and a lot of it will apply to commercial. And you can also look at it as in contrast to having multiple single-family homes, or 1-to-4s as we call it in the business. So on part one of this program, we went through the pros and the cons of having of owning a multifam property. I decided to discuss this topic, even though our main Wilson Investment Properties business is providing single-family home rentals to investors. We get a lot of people who say, gee, I have good credit, and I'd like to just jump right in, go past that little stuff and have a multifamily home, or property rather, and I've got good credit, and I've got a lot of money in income, and I would like to just go do that. Well, I can't consider myself a huge investor in that arena. I have friends who have thousands of units or tens of thousands of units. I've had 7 multifam properties, anywhere from 10 units up to $10 million, 176 unit property, and have helped others with it. So I have some enough experience, I think, directly and through others to at least share with you my experiences that will maybe help you in that decision. So I'll do like Steve Jobs taught us to do. I'll give the answer before at the very beginning, and then repeat it at the end, so you kind of anticipate what's coming. Basically, what I advise people is I would certainly keep a multifam property for your portfolio in mind. I think it can certainly give you a good balance and add some additional potential cash flow income, but I would not start off with that, even if a lender would loan to you. But I think it's something to know about. It helps you, if you understand that world, it can help you make your single-family home investments perform better. But I think for those that already have experience with multifam, or maybe have a partner who does have experience and can get a loan, it's something that you should consider, but know that there are a lot of moving parts. It's a lot more complex than what many people realize when you're putting together that sort of investment. Many people say, well, shoot, it's just a bunch of homes put together. No, there's a lot more that goes on about it that's unique to it. So again, today we're talking about the multifam property. We're doing this is segment 2. You can go to the segment 1 to see the basics of the pros and cons. And this segment we're going to cover how you go about getting one. So to recap briefly, by the way, this is KDOW 1220 AM, Wall Street Business Network, and this is Tom Wilson with Real Estate 360. We talked about on the pros and cons that the reason for considering it is that they can produce higher cash flow. You have some advantages of having all your eggs in one basket, and that makes it a little bit easier to manage. You can get non-recourse loans. You get some economy of scale. Those are some of the advantages. Disadvantages are you've got a lot of eggs in one basket. So if that's your only investment or primary investment, you've got a lot of risk sitting in one spot. So it's a little harder to predict cash flow. If there is negative cash flow, it can be large. You have to have professional property management to satisfy most lenders. It can be very difficult to get a loan. It takes quite a bit of time and work to locate one, and it's not very liquid. So that's some of the negatives, and you got more of those positive and negatives. Go back and look at the podcast for section 1. So today we're going to talk about all right, how do you go about buying one if you decided that you can get it and you want to do it? You want to have first of all, you got to define your objectives, and you got to get a team. You certainly no different than any other investment and any other real estate investment that you get. You got to get experts in that area to help you out. Don't try to do it on your own. What's your goal? Are you trying to get something that will cash flow immediately, or do you want to hold it long term? Are you instead trying to find something that's distressed? Do you think you can get it under value, add value to it by fixing it up, getting doing tenant improvement and occupancy, and then sell it for a profit, and that's because you've added value and you can sell it for considerably more than what it cost you to buy it and to fix it up. So got to know up front what it is that you're looking for. You got to look for, just like you would with a single family home or any other real estate, you've got to decide what city is your target. Typically you want a growth city. A city that has good economic growth and good employment growth, good population growth. Yet on the other hand, it's got to have the financial numbers that allows it to cash flow. There are many good cities economically, such as, say, San Francisco and Silicon Valley and Boston and New York, but the cap rates can be very low that reflect that. Cap rate, what is that? A cap rate is the way we really judge and compare most businesses. May be used a little bit more as a term in real estate than some other businesses. Basically, it's the percent of profit that you have after 1 year if you had paid all cash. So it gets rid of the variable of the loan and what the debt service is and so forth. So basically, if you have a $1 million investment and the income from it is $100,000 a year, and that first year, that's your net, then you've got 10% return on that $1 million investment, and you have a cap rate of 10. If you only get 50,000 net out of it, if your income minus your expenses, then you have a cap rate of 5. So your cap rate is very important. You need to target what kind of percent return that you want on your investment in order to decide where you're going to buy and what kind of investments to look for. Decide what class of property. Do you want a Class A, which has has lots of amenities, pools, security gates, gym, all of that sort of thing, and is a higher price product that's more attractive to the higher end market? Do you want a Class C or D that's that's maybe in not so good a neighborhood but has the potential of having more cash flow? And of course, what you have to determine in that case is, does what you pencil out on paper, can that come to reality? It may look like you can get it to be 90% occupied when now it's only 60, but if you can only collect from 80% of those folks that are there, then maybe you're not going to attain your numbers. Personally, I tend to like the B properties mostly. maybe upper end of C. I've owned A, B, and C. I've never owned a D. But I tend to find that the success is a little bit better below the top ones that you're proud to take folks to see, and the lower ones that can look really good on paper but are hard to actually achieve the results that you thought it would. So you got to decide how much money you want to invest, what's the size of it. I like to have properties that are large enough that have enough income to afford a full-time on-site manager and full-time on-site maintenance. You get economy of scale. You get more control over the property when you have that. The entity, you're probably going to need to have an entity. You've heard me speak before about not needing it for single-family home, in my opinion. But for a multifam or a large project, even without partners, typically your lender is going to require you to have it so they have isolation from any problem that you might have. But when you get up to that size, I think it's a good idea to have an entity. Now, whether or not you do it in a LP or LLC or S Corp or C Corp, you need to talk to your tax accountant and your attorneys about that, and that's certainly a different topic that we've discussed in the past, and we'll have guests on to discuss more in the future. So once you've identified something you like, you get out a letter of intent usually before you actually do the contract. You try to backdoor it a little bit so you're within target range before you do all of the paperwork. Once you're got an actual contract and agreement going, then you're starting to look for, do all of your due diligence, such as the region, the demographics, get the financial history, rental survey, the rent roll. You start to do all your inspections once you're under contract. Get all of your application ins for lender. We'll talk about that more after the break. And your inspections need to be for the property in general, but also the roof, the foundation, termite, engineering, many more reports you usually have for a multifam or commercial property than you do a single family. You generally assume that the expenses are not correct, that they have deferred maintenance, so the expenses look low in the last year or two. If you have a 40 or anything below 40% of their income as being expenses, then you can be very suspicious. We're talking about multifam properties today on Real Estate 360, KDOW 1220 AM. And right after the break, we'll come back and continue on the due diligence process of when you're trying to buy a multifamily property and all that you should do to minimize your risk and maximize the success of your multifamily purchase.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. We're discussing today multifamily properties as a potential in your future, if not now, and how that compares in ways to buying easier and simpler single-family homes. We're talking about the due diligence process of assuming you've identified a property after you've looked at found the region and found the property, and you have a broker who's very experienced in that particular region and that you can interface with, someone who provides the data, who seems to be objective. All of those characteristics are very important. By the way, in a future program, we're going to have someone on who's one of the most experienced commercial multifamily brokers I've ever known, and in fact has helped me buy a lot of products, and he'll add some practical spin to this. But I wanted to give you some prelude here to that, so that will be more meaningful for you. The loan process can be rigorous and very taxing. There's several different sources of loans. Of course, you can find some private money if you're fortunate, but the more conventional is to get a Fannie-backed loan, government backed, very similar to housing, except the multifamily commercial marketplace is quite different and a whole different set of lenders than you find in the residential, which is described as 1 to 4 doors. Once you get over 5, you're in a different world. The emphasis and focus is more on the property itself and how it performs than it is on you. But in this era of tight money, you get scrutinized more than you did a few years ago. They want someone who has a multifamily property now. They want someone who has experience with this, as well as being financially able to qualify. Again, if you want to get involved and you want to do an equity or share process and you have someone who's already experienced and you can get them in there and you're more the active person and they're the more the passive and there to consult with when you need to, that might be one approach. But just know the loan process is difficult. You got predominantly the Fannie-backed loans. You used to have a lot of Wall Street money, which was called conduit. Usually they have better rates, but the problem with it is that you've got usually yield maintenance or defeasance, which means a very high prepay penalty if you get out early. It's so much so that it keeps you from doing that, and you're pretty well stuck with that loan the whole way. And then you've got regional banks that are willing to lend to you, but not going to be as long a term, going to be weaker terms. Your debt service is going to be higher, so you have to have lower loan to value into it. But those are your primary sources. All of them, though, require a lot of paperwork, a lot of inspections, a lot of closing costs, legal cost, very involved process. I have one good friend who's my CPA, and he's been on the program before, who owns many properties, but he refuses to own a multifam because the loan process is just too more than what he wants to deal with. But having said that, many people do, individuals, not just REITs, and they've worked out just fine, as have some of mine. Back to the due diligence process, I said to get the expenses as a baseline from the provider, from the seller, get it from past several years. You can see trends, give you a basis of questions. Assume the expenses aren't correct. Assume they've deferred maintenance so the expense list can look low to make the profit look larger. If you see expenses that are less than 40 to 45% of the income, then you can assume that there's probably more expenses that you're going to have to incur, because that's not realistic, not typical in the business. You want to get the insurance claim history. You want to certainly, of course, tour the area, tour other properties, tour your competition, get a competitive report. That's the kind of thing you can hire out when you're up in this area, this kind of product. This is what attracts REITs, Real Estate Investment Trusts, and there are a lot of companies that service that business and can provide a lot of information to help you assess whether or not that's a property for you to get. So when we get back, we will continue with the due diligence process and the purchase process. We're talking about multifamily properties, if it should be in your future, and how to go about finding one and buying one. This is Tom Wilson with the Real Estate 360, and we are with KDOW 1220 AM, the Wall Street Business Network. We'll be back with you right after this break to continue discussing multifamily properties.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. We're talking today about the multifamily property, whether one should be in your future, and if so, how do you go about finding one and buying it. The multifamily property is a lot more complex than single-family homes, harder to get loans. Need to really have a team that knows what they're doing if you don't have a lot of experience with it. No substitute for going around and touring it yourself. You can rely, to some degree on others for input, but go get a feel for it. I always tell everyone, no matter what kind of property it is, if it's a rental or income property, after you've worked all the numbers, and from my engineering background and perspective and analytical approach, I like to really crank the numbers and not worry too much about if the kitchen's yellow or not. But in the end, when everything has been said and done, one good kind of acid test is to step back from it all and say, would I be comfortable with my daughter living here? And that'll kind of give you a little pause there for a moment. And if answer is I'm not so sure, then maybe that's not the property for you. You can get competitive reports because there are a lot of companies that support the REIT business that demand to have this level of input and due diligence. Go walk into the places of business. Every time I go to an area that's new or buying a sizable property, I go spend a fair amount of time personally, all by myself, no one else. I go into the local drugstore, I go into the local grocery store, I go to the downtown area. I just hang out and watch who's coming, who's going, what kind of cars are they driving, what do they look like. That can tell you a lot. Go to the actual property. Go park there during the daytime. Go park there at night. See who's coming and going into potentially your property. Is it the kind of people that your seller told you are there? Go look at all the lease reports. Go look at the credit reports. Did they stuff the property with a bunch of folks off the street just to make the occupancy look good? Or are they really folks that were indeed qualified? How good is the visibility, the signage? How well can the place be seen? How well does it attract traffic going by? What kind of capitalization is required? How much deferred maintenance is there? How much you're going to have to put immediately? How much further along? The strategy, what is your strategy for improvements? How much do you have to put in per year to bring it up to the level of property you want it to be? The application process is, as we've talked for the loan, takes very long. You can figure 4 to 5 months or more from the time you'd send the letter of intent to the time you close on one of these properties if everything goes reasonably well. What kind of entity? I think we touched on that. Insurance. You need to decide what kind of insurance and what kind of liability. The lender will dictate some of that, but maybe you want more. I always recommend getting good liability insurance. It depends on where it's located and your net worth and so forth. Certain states are more litigious than others, and if so, you may want higher limits of liability. And when we come back, we're now going to talk about the actual purchase and how let's assume you get through all that. It's a go. You close on it, and what do you do then? So this is Tom Wilson at KDOW 1220 AM, the Wall Street Business Network, and this is the Real Estate 360 program.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. Talking today about the multifamily property as a potential in your future to consider and how you go about identifying it, what the pros and cons are, what's the due diligence process. So we've covered all of that through the prior segment and through today. And now we're going to assume the due diligence process yielded a good result. If there are some things you didn't like, you negotiated the some money relative to getting those things fixed or those surprises. And again, you want to have a good agent who's very familiar with that whole process and that keeps you on in contract. Some agents and brokers just don't seem to be sensitive enough to the importance of following the contract, following the deadlines, letting you know ahead of time, warning you that in 3 days at noon that the inspection report has to be complete and you need to decide if you're going to remove that contingency. And all these kinds of things, if you don't perform in time, you can be out of contract. And if the seller wants to walk, you're done. So treat those things very carefully. So let's assume we have a product you want to buy, you're going to purchase it. You make sure when you own a property that you take now, you're at a higher level than a home, and requests from government agencies, local cities for inspections, insurance, lenders for inspections and reports, take them seriously. They mean it. This is a different business, different world. They need professional property management. They need a property manager there that they know has success in managing their investment as well as yours. Get yourself a great office manager, can make or break the whole thing. If you have a minority in the property, make sure you have an office manager, if you possibly can, that's bilingual and can also speak their language. That can make a big difference. The maintenance person is critical. You want them to give you good value, but they got to be able to be dedicated to the business and make sure that they're have a sense of urgency. Make sure that they can handle all of the maintenance items, or that you have other subcontractors that handle specific things like pool or landscaping. Who's going to handle the make-readies? You're going to do that in-house or you're going to farm it out? Capital repairs, how much you're going to do up front, how much you're going to budget per year. Make sure you have that in your reserves. The tenant profile, you're going to move those goals up or down. You're going to move the rent rate up by how much? What's the trade-off between being too greedy with the rent versus having maybe lower occupancy than you want? What kind of advertising you're going to do? Where are you going to advertise? Is this the kind of clientele that's going to be attracted by the internet? Or maybe they can't afford internet computers and you're going to have to attract them by posting signs in the local laundromat or the in the local little neighborhood flyers. Master meter. How many of the utilities are master metered or sub-metered? If they're master metered, maybe you can put in sub-meters, or maybe you can come up with a way that is allowed with the local ordinances to bill a portion of, say, the water, which is often the case, out to the tenants. But you got to figure out how much is being used for landscaping in the office and subtract that. Important to have a good landscaper. Accounting system. What kind of accounting system are you going to have? Hopefully your property manager has already selected that and you like it. But in this level of business, to make your lenders happy and so forth, you got to be able to have an accounting system that can produce a balance sheet as well as accrual and cash flow. Produce the good P&L report on a regular basis. How's the reporting system? You're going to mail your paper. You're going to have online access, which is better. How often you're going to communicate with that property manager? The answer, of course, is more often up front than it is as things are going well, or more often if you have problems. You're going to need to decide and discuss about setting and raising rents. Are you going to add any amenities? The barbecue, pool, laundry, security gates, clubhouse, activities, gyms, security cameras, add or expand laundry. So let's talk for a moment here in our last minute or two about NOI. So NOI is the net operating income which is all of the income minus the expenses. And this is a number that you use before debt service because it makes it easier to compare different performing properties, because the debt service can be quite different depending on what kind of loan you get. NOI is what drives the value of a property and drives what you can resell it for. So it's a very, very important number to understand and know. So how can you increase the value of the property? Well, by increasing the income, raising the rents, raising the occupancy, cutting expenses where you can, hopefully in a way that does not cut down on attracting people to come, or your tenants to come there. But you can think about improvements. Let's say, for example, there are no washer or dryer hookups, but you can put them in for $1,000 a unit, and there are 100 units there. Well, $100,000, yikes, that's a lot. But let's say you can charge an extra $35 a piece because of that. So that would be 33 times 100, or $3,300 a month, and in a year that would be for that $40,000 you would more that you would bring in. So that $40,000 says it would take 2 years and a half for the payback. But even more importantly, if you have a cap rate of 10, which means that without debt that property earns 10% per year, then that $40,000 extra income per year with a cap rate of 10 says you just improve the value of that property by $400,000, right? Cap of 10 times a $40,000 higher income, $400,000. Wow, that was a pretty good investment, wasn't it, for putting in $100,000. So that's some of the kinds of things you can do. What gets exciting and interesting about this kind of product that you can work with. So those are some of the things that you need to do after you buy the property, and that are very, very important. So we've worked with you about all the different elements that you need to review and look at, and we'll come back and recap here in just a moment on Real Estate 360 about multifamily properties. We'll be right back.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. Well, this has been an interesting sector, I hope, for you, to give you a little more insight about multifamily properties. On one hand, maybe it has encouraged you to consider it in your portfolio sooner than expected. On the other hand, it may have convinced you that, wow, there's a little more to it than I expected, and maybe that's not a good place for me to be yet, or maybe even at all. So, short recap here. We've talked about should a multifamily property, apartments, be in your future. We've talked about the pros and cons in the first segment that we did a couple weeks ago. It's you can get more cash flow. It can be a little easier to manage because it's all doors under one roof. You can get non-recourse loans. There's an economy of scale. Cons are you do have a lot of eggs in one basket. It's harder to get loans. If it's not performing properly, it can be a real serious problem. We've talked about the due diligence process. How do you go find a property? How do you find a team? What are the things you check out? And when you decide to buy a property, what are some of the things that you have to do to make sure it's managed correctly, and how do you improve it? So I hope all of those things were helpful. And we're going to have here in a couple of weeks, we're going to have a guest on who has, I've bought and sold $35 million worth of multifamily properties with, and done some syndications. And he is a outstanding broker, a CPA, and broker. And he's going to add some practical aspects to what we've covered, and I think you will enjoy that. Again, my recommendation is don't start off with something like that. Excuse me, even if you can find a lender. So I suggest having several multifamily properties, several single-family properties first. You can sort of treat that as your kind of mutual fund of homes and get some of the advantages of multifam without some of the complexities and concerns. But, keep that in mind for future, because that's something you might want to consider. If you want to get a weekly economic newsletter that gives you a snapshot of what's been going on in the world as it relates to real estate, go to TomWilsonProperties.com and sign up for that. Also, I have a report that tells you how to select the best metro and the best products that you can request, and we'd be glad to send that. If you have ideas for subjects and topics on the program or questions that come up that you'd like answered, let me know. And if you'd like some consultation on your investment strategy and portfolio, be glad to meet with you for a free consultation for an hour, and just let me know that you would like to do that. So, again, we are very looking forward to having a broker by the name of Steve Fithian on in a couple of weeks. I hope you've enjoyed getting a little overview about the multifamily property business. And we will be back with Steve here and go into some more of the practical aspects of doing that. Nice to have you with us. Always is here on Real Estate 360, KDOW 1220 AM, the Wall Street Business Network. And remember, the only thing that matters is what you do next.
You've been listening to Real Estate 360 on AM 1220 KDOW. For more information on today's program, visit RE360radio.com. That's RE360radio.com. AM 1220 KDOW.